Greetings, everyone. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit GPC. Let's get started with the monthly strategy update. So this month, we're going to start our review with our view on precious metals, gold in particular. Gold started to rise dramatically late 2022. And the reason for that is the actions that were taken by the banks in Europe and US to freeze Russian assets, which led to a recognition by central banks across the world to diversify their holdings, and most central banks have chosen to increase their holdings and allocation to gold since that time in particular. Those trends have accelerated. Before we get to that, the US debt continues to rise, 37 trillion, a very aggressive maturity schedule in 26 and 27. So clearly not much progress in terms of controlling the debt has been made, not just in the US, but even across initiatives across Europe and Japan, as well as China, continue to suggest that on a global basis, debt is likely to continue to rise. Coming to central banks, the acceleration is fairly visible in terms of what was happening prior to 2022 and post 2022. The move to purchase accumulate gold has already accelerated, and that continues. And U.S. investors in particular have been fairly under allocated with holdings, some most cases 2 to 3% of portfolios, and so we're seeing a rise in ETF allocations in the US. We're seeing that across really most parts of the world. And so our thesis on gold continues, and there's no change despite the recent volatility. We believe gold should be held in portfolios as a strategic asset, as a very effective hedge, and our fundamental view on gold, which we turned positive and overweight in March of 2024. We remain overweight gold and continue to do so. And now diversification has also played out in a different way. So diversification really is one of the key trends of 2025. And the other way that it's played out is by increased allocations and flows heading to emerging markets, as well as Europe and other parts of the world. But in particular, emerging markets have done extremely well. This is something we've talked about for at least the last 3 or 4 months. We've pointed out some of the reforms that were underway in Korea and the prospects for positive market outcomes, as well as in Taiwan and Japan, and as well as some of the tech opportunities in the Hang Seng and Chinese markets. So clearly there's lots happening in the emerging markets. We've covered these markets in more detail this month with a far more focus on what's happening in the global markets. And we urge you to take a look at our views on the various markets that I just talked about. Now, the other thing that's playing out for emerging markets is the weaker dollar, and we've listed many of the reasons why this and other factors are working in favor of emerging markets. Would urge you to take a look at that if you're interested. Now, adding just a little bit of color on Korea. KOSPI is the top performing index across major markets, including the US, technology markets, Taiwan, etc. And there's many different factors underway that are leading to the optimism and the performance. And it's also the earnings have been coming through. So this is the contribution to earnings. To the index by earnings, and that's valuation. And so clearly earnings are driving the markets higher, and we think that this is the reforms that are underway are likely to continue. So clearly one of those markets that's fairly priced and has some interesting drivers that are going to take it to high levels in coming months. So we'd be remiss if we didn't talk about India, being an India-based firm. So one of the things that we've been hearing about India is that the markets have not done well over the last year. And one of the reasons why that view may be prevalent is because of the construction of the Nifty 50. And so the names on the left here are the names that are the underperformers, and very well represented in that list is information technology. Five of the majors are all down 12 to 25% over the past year. And now add to that some of these other names are old economy names, NTPC, Coal India, Power Grid, ONGC, also all down double digits. So very tough for an index to perform when it's being dragged down by names that have double digit, 20% plus, in some cases are down returns for the year. So what's been working, and there's a fair bit that's been working as well, and these are the names, largely quality growth stocks. And so these names have done extremely well. So the notion that India is that opportunities are not working in India are not necessarily true. The one needs to really have a thesis that is focused on the right parts of the market. And I think that's been our view for the last few months now, is that stock selection will matter and returns will be more dispersed as we go forward. And stock selection, sector allocation will be far more important. Coming to our investment themes and wrapping up, quality and growth, predictability, thematics, those are the things that we would look for as we continue to move into 2026 with a fair amount of uncertainty out there. That's what's working, and that's what we think will continue to work. We've already talked about emerging markets, and so we cover our views of Japan, Korea, Taiwan, and also China selectively. And so that's another area that one would look at in terms of structuring portfolios as we move forward for investors that are interested in diversification at reasonable valuations, and that would provide earnings growth as well. In terms of gap, our view on the broader geographic global marketplace is that large continues to dominate, particularly in the US and across many other markets in Asia as well as Europe. Large caps are dominating, and emerging large caps or mid caps are also that are dominant are interesting. But when it comes to India, we think the opportunities for excess returns really lie in the mid-small cap space. And for large, we think there's 12 to 14% kind of earnings growth and similar kind of return. The larger returns are likely to come out of mid and small cap exposure via active managers that have experience picking in these spaces. In terms of thematics, the infrastructure space, the platforms, materials, energy, technology, and financials are all areas that we'd be interested in participating in, and a lot of that is stock specific, but those are some of the themes that we're interested in and we think will do well. We already talked about our view on gold. We'd be looking to up our exposure to commodities should we continue to see a tick up in inflation, particularly on the metal side. And so that's something that's on the watch list. Coming to fixed income, inflation protection is our primary concern, and generating a real return in excess of inflation is really going to be the theme for us for 2026, and that would be infrastructure, REITs, infrastructure assets, and similar selective opportunities. And again, active management, in-house due diligence is the other way that we're gaining exposure to these markets. And if you're interested, please do reach out to us. We have opportunities that are proprietary in terms of return structures. Coming to privates, again, we are selective in terms of the opportunities that we look for, and that remains the case as we go forward into 2026. Thanks for watching. See you next month.